Yeah, so these are just kind of common questions that I've seen a lot of traders ask over the years in Traderline Private Access during master classes. Where do I put my stop? How do I manage risk? How do I handle gap downs? What should my position sizing be? When to sell into strength? As we'll cover today, there's a lot of nuance regarding these topics and a lot of answers, but we'll do our best to provide some really concrete guidelines and frameworks that you can use to answer these questions. And a lot of it does depend, we've come back to the idea of where are you in your trading journey? Are you a stage one trader just starting, stage two, starting to get a feel of it, stage three, are you actually focused on performance at that point? The answers to these questions will vary along your journey, but there are concrete steps that you should take to answer these, and we'll provide some great starting frameworks today in today's webinar. So jot in the chat right now any other key questions that you'd like us to answer today. I've seen a lot of these in the previous webinars, but we definitely want to make sure we're answering as many of your questions as possible. So yeah, with that, I think the next slide. Yeah, so I wanted to kick off this first section with a quote from the legend, William O'Neill. Buying a stock without knowing when or why you should sell it is like buying a car with no brakes, or being in a boat with no life preservers, or taking flying lessons that teach you how to take off but not how to land. Basically, if you're not managing risk, you're not approaching trading the right way. You're not thinking about the downside. You're only thinking about making 100%, doubling your money, tripling your money, quadrupling your money, or whatever. And that's not realistic trading. And you always want to be thinking about capping your downside, even when you find a great opportunity that you think has a lot of potential, because we always want to be prepared for the worst. And capping our downside is actually what allows us to stay in the game over many, many market cycles over decades and compound our accounts. It's no good to double, triple your money, not really thinking about risk management in a year like 2020, where everything's easy, everything's working, everything goes up 20, 30% as soon as you buy it. But when that down cycle hits, when 2022 hits, you give it all back and then some. So risk management, sell rules, it's an even more important part of the equation than making the big money. So you have to learn how to keep your losses small, as well as get out when the trend ends. And that's what we'll be talking about in today's session. All right, so here's another slide to kind of emphasize this point. You guys have probably seen similar tables to the one on the right. Basically, we've got a column that's a percentage loss. And then on the right-hand side, the right column is from that loss, what is the percentage gain that you need to get back to just where you were, to just get back to break even? And you can see that, under 10%, it's pretty much an equal relationship. You need a 1.01% gain to make back a 1% loss. At 5%, you need a 5.26% gain to get back a 5% loss. But very quickly, if you let losses get too big, and at this point, we're kind of thinking in terms of individual positions, if you let losses get too big, the gain necessary to get back to break even just becomes an insurmountable barrier. There's not often that a stock is gonna, double easily for you. So why should you expect it to happen after a 50% loss, or, don't expect a 300% return easily after stock drops 75%. There's a reason that these stocks fall so hard. And often that's because they're under significant distribution, need a lot of time. And even if they do resume an uptrend, it's going to take a lot of time, a lot of work, and you're better off capping your loss when geometrically you're not being worked against. You don't need much of a gain to get back the loss you have. So in terms of the bullet points here, losses work against you. Large losses are disastrous, as you can see from this table. Don't be a sore loser. I think Rye added in that bullet point. Accept the small losses, because that's the only way to prevent yourself from taking large losses, and work the math manually to cement the concept psychologically. So I'd really encourage everybody to make a table similar to the one I've done over here. Think about, the losses that you've taken in your trading career. I'm sure a lot of people have examples where they've let a stock drop too far too fast, and they either hung on because they're just hoping, or they just kind of moved on to another stock. But I'm sure everybody has those examples. But the key thing is keep those losses small, because that requires a lot less work, a lot less gain to get back to break even than when you let those losses kind of snowball and become extremely big. And Ryan, anything to add with this point on this
Yeah,
slide?
so a few things. One is you make sure you could pull up a chart of let's say SE, PayPal, Square, and say
Roku,
that if
yeah.
you, yeah, Roku, any of these names that have you know, went from 300 to $50, and just do the percentage math on them, and you will quickly see that this relationship that we're talking about, where around 10%, it's kind of like a linear line where 10% loss, you need 11%, but after 10%, it gets really, really bad, really, really quickly. And the stocks that we just mentioned, they've halved and half, they've gone down, $200 from their highs, and it gets really bad. And we see people holding those stocks, thinking that they'll, one day they will come back. They're not going to come back for quite a while. Like Cisco, if you pull up the 20-year chart, it took 18 and a half years for it to come back, right? Unless you're willing to wait that long for you to somehow break even after 2008, 2009, then that's a good strategy, and you can function upon that. But many of us that are here today are positioned in swing traders, and we need to understand the fact that when the market says you're wrong, and especially you just look at this visual table, especially when you're drawdown on your position or drawdown on your account is around 10%, it's going to get worse every single day, or every single kind of percentage you get away from 10% at the end of the day. So there's this other notion, this other thought process that a loss is not a loss until I sell it. And if I have an open position, I'm not kind of losing. I'm just waiting for that, my 15% drawdown to go back to 10% or go back to 5%, and I'll get out of it. All of this, we've done it. All of us, the 300, more than 300 people that are here have done that same thing. But you need to make sure that risk management starts with looking at the loss side and not the profit side. And you need to, maybe in the comments, if you guys can say, put what your max stop loss is, and what you have, what you're using today. And if you're not using one today, you need to set one today for you to even have a chance to be a position and swing trader in the market. So uh, the last bit of it that I want to emphasize is just do the math manually. When you actually see the numbers, like if you have a $30,000 account, if you have a 15,000 or a $10,000 account, just do the math and say, okay, if I were to do this, how much do I need to get back to even? Once you do it manually, you'll see it for yourself, and your body or the back of your mind will never allow you to be that bad from that point. A lot of people just don't seem to do it. You could look at this table, you could hear me and Richard say it to you, but once you actually do the math versus your account, like it psychologically just is embedded in how you function in the market. So I see a lot of people saying 5%, 8%, 4 or 5%, 2 to 5%. So that's good. At the very least, just have a number, right? That's what we want. And if you don't have a number, you're kind of just goes back to the William O'Neill quote where you're driving a car with no brakes, and that's really never a good sign. So
Yeah,
um,
perfect. And I think the next slide, just some risk management rules. This is a little bit about what we're covered today, and it's important concepts. Total open risk, at any given time, what is the drawdown or dollar loss that you will experience if every single one of your positions gets stopped out? Hard loss percentage, we just talked about that. What's your max stop loss percentage? Your max position size. These are all rules that you should have written down. What is the total number of positions that you'll focus on at any given time and have open? This is kind of an aspect of risk management as well, because if you're stretched out among 20, 30 names, you're not going to be able to give every single one of those positions the time and attention needed to manage it correctly. It's just not possible. So we'll talk about some recommendations, some guidelines for a number of positions today. Calculating your average win, average loss. This is stuff we'll get into more when we cover the post-analysis webinar. Equity curve analysis, we've already been through that. Focusing on limiting those pullback periods, trying to get that, that rising curve from left to right. Your batting average, that's another one of the key summary statistics that we'll focus on when it comes to post-analysis. I think that's webinar 7 or 8. So, but these are really key things that you should have written down and cemented in your rule set. And very quickly, before we actually dive in, we'll be talking a lot about rules today. And if you don't have a rule set written down as a trader, you have not done the due diligence needed. You have not put in the work, as Gary Vee has said, to actually excel at this endeavor. If you haven't written down your rules, you haven't thought through your system, and you shouldn't be placing a trade. So in the chat here, I want to see how many people have actually a written rule set down, walking through how they screen for stocks, how they enter positions, how they set their stop loss, all of that. So be honest in the chat and let us know here. So that's good. I see people coming through here. Perfect. And if you don't, this should be a wake-up call. Why are you risking money in the markets when you haven't thought through your process? A lot of people, do a lot of research. They're buying a vacuum. They'll do research. They'll compare reviews. They'll compare ratings. They'll do all the work necessary to get the best deal. If you're not willing to put in that same work and effort into an endeavor that, over decades can really make you a fortune, that doesn't really make sense. So put in the work, and this is a great start today that hopefully you should come away with some concrete rules and guidelines to start off your rule set.